Dear students, this video will cover international trade. When I was younger, I imported stuff like this, scuba equipment from one place to sell it more expensively somewhere else. I also worked on importing Russian night vision equipment when that was like the only place you could buy it in the world. So I bought that cheap and sold it expensively, and that way I had a profit margin that was very decent and paid for my way of life and enabled me to later on invest more money into the stock market. And that, my friends, was a good thing. This video will cover international trade. A simple definition of international trade is that you buy something inexpensively, a good or a service, in one location, and then you sell it at a different location at a higher price, generating a beautiful profit margin. International trade is a very old concept. It's been done for thousands of years. One person that became very famous for international trade was Marco Polo. He was a merchant in Venice before he became a famous explorer that we know today. When he was 17 years old, he left Venice with his dad and his uncle and traveled the Silk Road all the way to China. He traveled the Silk Road between 1271 and 1295. Marco Polo lived to an age about 70 years old, so he had plenty of time to write down his memories in a book. Marco Polo was very good at taking one concept from one place, for example China, and bringing it back to Italy and making money on it. Everywhere from like pasta to paper money or different types of recipes, silk, china, and other goods. And by exploring the cultural differences, he was able to find new opportunity sets. That's why international trade is so exciting. Now, I like to recommend books every so often, and Rich Dad, Poor Dad is a wonderful book that everyone should read. It's by Robert Kiyosaki. I'm sorry if I murdered his name, but Rich Dad, Poor Dad is an excellent book that you should read. It will really teach you about cash flow. In his case, he focuses more on real estate, but understanding cash flow and how you can make cash flow work better for you is a good thing. You can apply this concept of cash flow in international trade. Today is easier than ever to make money on international trade. You can go on Alibaba.com, buy things for bulk, have it shipped directly to Amazon, and all you need to do is advertise and sell whatever you bought at a lower price at a higher price and make a beautiful profit margin. And that's one way how you can use cash flow to make money. When Marco Polo went out to travel, he had a bag of money and bought things, and then he brought it back home and sold it. That made everything seem really simple. You have money, you have a transaction, and you get, stuff that you want, and then you sell it at a higher price. Today, when you do things, a lot of these items that are required to be fulfilled by regulation is done almost by automation. But to better understand how things actually work when you go and buy something from Amazon or Alibaba or something like that online, is that all of these things actually happen in the background. That's why trading platforms like eBay, Alibaba, Amazon, and so on is so popular and so efficient and is making so much money and making so many millionaires is because they have simplified this process. Now, if you were going to pick up the phone and call someone in China and do things the old school way, this is how it needs to be done. So you would be the importer and you would talk to someone who's the exporter that you want to buy something. You guys agree upon a price, which means that you have to make sure that you are safe, and you'll have to talk to the importer's bank. Okay, that's you. Okay, how are you going to pay for this stuff? And how are you going to ship that money over to the exporter's bank? Okay, and once that's done, there's indirectly by the banks, a letter of credit extended. Once this is done, the exporter is notified and they start shipping the goods. Now let's simplify this. You find something on eBay that you want to buy from an exporter in China. You say, I dig it, I like it, and I'm going to pay you. So you click buy it now, and what happens is that PayPal will help you with that transaction, and then you get an email say done. And that means that both you are notified that you have paid someone, and the exporter has been notified that they are paid. And that is when you'll wait to see when will this good be shipped, because the exporter will then enter that into the eBay platform to show that you have actually sold something. Not sold, that you bought something. And so when they accept that you paid them, they'll send information through the banks and back to you. The reason why it takes so long sometimes to have things shipped is that they have to put it in a box, they have to write out a label and maybe some customs paperwork to have it shipped to you. Some accounts like eBay, Amazon, Alibaba, and so on, they will actually help the seller draft that paperwork. So all they need to do is actually print a label, and then everything else is taken care of. So some of these platforms actually help the seller collect the tax and pay the taxman and all that. And that's why the infrastructure of these trading platforms are so valuable, because it does all these nitty-gritty little annoying things that has to be done because of regulation, because of tax code, because of tariffs, and because of how you ship things. All of that has to be put in place, but the platform will simplify it, and that way you don't have to pay so much attention to all these weird little things that happen in the background. But you need to know what they are and how it looks like. So take a good look at this and pay attention. So a letter of credit is a guarantee from the importer's bank that it will act behalf of the importer and pay the exporter for the merchandise if all relevant documents specified in the letter of credit are presented according to the terms of the letter of credit. In essence, the importer's bank is substituting its creditworthiness for that importer. Okay, that is what PayPal does for you. Okay, they will just make sure that money is flown. Okay, so if you're paid for something and it's not sent as shipped or collected, that money will be earmarked right there. You can see it on eBay and PayPal. And so from a payment point of view, it has never been easier ever to do international trade. Now, some multinational corporations, they don't use eBay, and they don't use Amazon, and they don't use Alibaba and so on. They negotiate directly with the vendor just to make their profit margins increased a little bit. So one of the things that they might need is a time draft, which is a written order instruction the importer or his agent, the importer's bank, to pay the amount specified on the face of the certain date. Okay, and that's what you do when you use PayPal. You say, I'm going to pay them right now. Okay. A bill of landing is a document issued by the common carrier specifying that it has received the goods for shipment. It can serve as a title for the goods. A banker's acceptance is the exporter's bank presenting the shipping documents and the time draft of the importer's bank. After taking title to the goods via the bill of landing, the importer's bank accepts the time draft. At this point, the banker's acceptance is created. It is a negotiable money market instrument. A secondary market exists for bankers' acceptances. Bankers' acceptances can also be held to maturity by the exporter's bank or the exporter. The exporter can also sell it at a discount in the money market market. You can see it as a payday loan kind of thing. Since the risks are similar for bankers' acceptance, trade at rates comparable of certificates of deposits. Yeah, you indirectly create a CD for your merchandise. Some of the important things to pay attention to when it comes to the risk is that maturity is too long, the loan is too large, the loan risk is too great, and hard currency. A lot of countries that people are doing business in, companies are doing businesses, don't have a strong currency. That's a major risk. Countertrade is when a government of one nation state is negotiating to open the doors and do business somewhere else. Assume that labor costs are too expensive in, for example, China, and now multinational corporations need help by the U.S. government to negotiate lower costs of doing business in other places. So they decided to do more business in, for example, Rwanda. And in Rwanda, there's not very strong ties with the United States. I'm making this up now. So we come up with ideas of how we can do trade with them, and they cut a deal. The U.S. government cuts a deal with the Rwandan government that we will export things to them, and they will buy it from us, and we will buy things from them. Now, they don't have any money, so they need to make money first. So they need to encourage U.S. companies to buy stuff from them. So they might say, okay, we'll do some foreign direct investment and stuff like that. And that means that you have to have some sort of counter trade put in place. And that means that it's a government-public negotiation in this case. So if you want to do business somewhere, you might want to just pick up the phone and call the ambassador and say, hey, I want to do business in Rwanda. Can you help me out here? This is what I'm looking for. But you can do it with any country you want. So countertrade is an umbrella term used to describe many different types of transaction in which the seller provides a buyer with goods or services and promises in return to purchase goods or services from that buyer. Countertrade may also not involve the use of currency as barter. When you barter for something, you indirectly exchange one good for another, okay? So the direct exchange of goods between two traders. Barter requires a double coincidence of wants. Assume that one country has a lot of cocoa beans and another country has a lot of oil. Instead of exchanging things for money, buying cocoa beans for dollars and buying oil for dollars, they would just exchange X amount of barrels of oil for X amount of bushels of cocoa beans. Sometimes to keep track of this and have a trade balance, you might have a clearinghouse arrangement, which is a form of barter in which the traders agree to buy a certain amount of goods from each other. Okay, typically the government keeps track of that, and there might be penalties involved in case it doesn't happen. Now, they set up an account with each other that are debited and credited as needed. At the maturity of the arrangement, the parties settle up in cash or in merchandise. Another form of counter trade is putting in place a switch trade, which is the purchase of a third party of one country's clearing arrangement and the balancing for hard currency. A buyback transaction involves a technology transfer via the sale of a merchant manufactured plant. The seller of the plant agrees to buy back some of the output of the plant once it's constructed. That's an example of when foreign direct investment is done, okay? So we might need less expensive labor. So we do foreign direct investment in a country like Rwanda, and we build up a factory there, and then the company that puts up the factory there promises to actually buy the goods and services provided in that factory. A counter purchase trade agreement is similar to a buyback transaction, but differs in that the output that the seller of the plant agrees to buy is unrelated to the plant. An offset transaction can be viewed as a counter-purchase trade agreement involving the aerospace and defense industry. One of the first things that Boeing does when they build a new plane is to have these trade agreements around the world where they say, okay, if we build the right wing in Mexico, how many Boeing planes are you willing to buy, Mr. Mexico? And then they will go to India and say, hey, will you manufacture the left wing for us? And then we'll pay you for it. But in exchange, would you be interested in buying X amount of planes? What would that be like? So what they do is that they really look at where can they outsource stuff and have things built. And the reason why they want to do that is to encourage the local governments and companies in those local countries buy planes from Boeing, so they know that they have customers lined up. By entering into these types of agreements, Boeing can then make sure that, one, they're creating jobs, and that makes the governments happy around the world, that they're creating jobs in their country, but also that they have buyers. In the end of the day, everyone makes money. Of course, there's disadvantages of counter trade. One, it's inefficient. Some claims that such transactions tamper with the fundamental operation of free markets, and therefore resources will be used inefficiently. Transactions that do not make use of money represent a huge step backwards in economic development. For a company that's involved in making chocolate, it's much easier for them to just go out and buy cocoa beans, make the chocolates as they see fit, and then sell it. Setting up some sort of counter trade situation here doesn't make sense. Mainly because making chocolate is not that complicated. Now, when it comes to airplanes, it's a different issue because they are big, complex, takes a lot of resources, and are very expensive. So that's a totally different game compared to a lot of the small things that we take advantage for. We wouldn't set up pencils as a part of counter trade. That does not make sense. An important part of counter trade is that it conserves cash and hard currency. Now, in some cases, some nations actually want to have the ability to receive hard currency. So a lot of countries will say, we would like you to spend your US dollars here. We will accept you to pay us in US dollars, because that will help them put up reserve requirements for their banks and their national banks and makes their economy stronger. But they're typically not very happy in paying out in US dollars, because that will cause significant stress on their local currency and financial markets. So when it comes to counter trade, some of the advantages include the improvements of trade balances, the maintenance of export prices, enhanced economic development, increased employment, technology transfers, market expansions, increased profitability, less costly sourcing of supply reduction or surplus goods from inventory, and the development of marketing expertise. This is how business has been done in China. Some generalizations about counter trade is that there are advantages and disadvantages associated with counter trade. It can benefit both parties in some circumstances, and sometimes it's the only option that you have. Whether or not counter trade transactions are good or bad for the global economy, well, it appears that they will increase in the near future as the world trade increases. No, that does not mean that we're going to do more business with China. What it means is that there's a lot of countries out there that would like to engage in international trade that currently is not doing much of it. Just pay attention to when was the last time or ever that you saw a little note on something that you bought, made in Africa, or made in Morocco, or made in South Africa, or Congo, or Somalia. All these countries that are currently not engaged, super engaged in international trade, they want to do it. And you can be a part of that transaction. Dear students, I hope you liked this video. If you did, please subscribe by clicking up here and give me and maybe even write a little comment down below. So I appreciate your help and your support, and I hope you enjoy these videos on finance.